Hi, this is Sean O'Toole from Exercise Your Options, and today we're going to talk about put options. Specifically, we're going to talk about buying put options, why you might buy a put option, when it's appropriate, and what the risks are of put options. So let's take a look at the graphs. This is the best place to start. Just so you know what we're doing specifically. The number we're using a $5 put strike. We're using 60 days, 30 days, and 5 days for various examples. And we're going to use a couple of different volatilities. We'll start at 50%, and then we're going to compare a much lower volatility to that 50%. So typically, start out with why to use put options. If you're a stock buyer, it's a way to benefit from a price decline without having to go through the complexity of selling stock short. Some accounts can't sell stock short, but they can buy put options. So it is one way to enter the marketplace that otherwise would be restricted to you. It also offers limited risk. There's a defined price at which you bought the option, and you cannot lose more than the purchase price of the option. So it is a nice way to enter into a transaction such as a short sale. In the commodities world, the same thing, defined limited risk. Also, there are instances where a producer, say in the grain business, rather than stepping in and selling the futures market short where he is subject to variation margin up and down, it may make sense from time to time to just simply buy a put option and forget about it, and just that put option is there as a floor in case the market goes down substantially, but he really wants the market to rally, so he's going to hope that that option expires worthless, and he sells his grain for considerably more. So on the when to use side, I always tell people I'm personally not a big options buyer, at least not naked options like just straight out puts and calls. I'll buy strategies that involve long options at times, depending upon what volatility levels are. But generally, I'm not a big long options holder. So when would it be best to use? Well, when volatility is low. And how do you judge that volatility? Well, best to judge volatility relative to itself. And that's because volatility or implied volatility, the volatility that comes from the model, the Black-Scholes model, when we input time to expiration, underlying stock price, what the strike is, and what the interest rate is. From that, we can derive implied volatility. Implied volatility, volatility in general, is mean reverting, which means it tends to go to extremes and come back to an average price over time. It may be climbing for whatever reason or descending, but it's going to rally up and come right back down. Go down sharply, come back up. This is what volatility does. It's not that surprising when you think about it, as frequently options buyers come in a position of fear or greed, especially fear. If they believe that the stock market is going down, they'll load up on puts. It drives the volatility of puts higher. Therefore, the market is set to then sell back to the mean at some point in time in the future, usually relatively quickly. As soon as all that put buying stops, the market will correct and revert back to the mean. Now, the risks in buying put options are really twofold. One is that the underlying asset goes up in value and the option expires worthless, and that's simply a factor of price. The other, more stealth risk, is volatility. If you are buying an option at a level of volatility that's higher than where the volatility is going, you're going to see that option price decline in value regardless, unless the market spikes dramatically, which would usually drive volatility higher anyway. You're going to see, if the market is slow to move, you're going to see volatility decline, and your option is going to decline in value along with that. So let's jump into the charts and just take a look. This is, if you remember back to my call series, I am not a big fan of buying out of the money options, and I'll show you why. Generally, again, this is 50 volatility, so it's pretty big volatility, but it's a good place to start. We'll take a look here. As I said, this is a $5 put. So we'll 45 cents out of the money with 60 days to go, the blue line. A $5 put is going to be worth about $23.40. If the market were to do nothing for the next 30 days and go down to the 30 days till expiration mark, you'd be at 12 and a half. So you're looking at 11 cents of decline over the course of 30 days because the market does nothing. If Let's look at it differently. Let's say the market does go up to the $5 number, and it takes we run from $5.45 to $5, and it takes 30 days. We buy the option at $23.39, and we're at $28.55. So we've made a nickel. We've risked 23 cents. We've made a nickel over the course of 30 days, with the market going exactly where we thought it was going to go, 55 cents higher. Not exactly the best way to earn a living trading options. You're going to lose more often than not. Just to quickly go to the other side, to the other extreme, where I tend to want to play if I'm going to be buying options. Here we are, 55 cents, 45 cents rather, in the money. With the market at $4.55, I'm buying the $5 put. I'm paying 65. If the market does absolutely nothing, I'm going to lose money. It's going to be a drop of 9.5 cents over the course of 30 days. However, if the market does go up, let's say to the 4.25 level here, we're going from 65.07 up to 79. So at least my returns are better than they are on the out of the money side. Obviously, the further in the money, the closer these lines are going to come together and the less decay there is, which is also apparent in the theta chart. Theta is the reflection of time on an option, and as you can see here, theta is greatest at the money, and as you approach the 4.25 number out here, theta is very, very small. But what I wanted to show you, I think the biggest takeaway on all of this is what volatility does to a position. And I mentioned that one of the risks is volatility goes down. Let's say we go from 50%, the market just dies off entirely, and let's say we drop to 20% volatility. This may take a moment. The options add-in that I built is very, very slow. I need to refine it, but it will work here. It just takes a moment. Okay, remember how wide the lines were. If we take that same level, let's say we're jumping into the 440 level, for instance. I think I was looking at 455s. Let's jump to 455. So we put this on at 47.27 with 60 days to go. The market goes absolutely nowhere, and 30 days later, we're at 45.53. So we've lost just 1 3/4 cents over 30 days. That high volatility is what keeps the lines apart. That's what keeps the large theta decay in play. And the lower the volatility, the tighter these lines will be. If we were to take this to, say, 1% volatility, the lines would be right on top of one another. Of course, a $5 market, I'm using, for instance, what typically looks like a wheat market, and it's not going to be, it generally is going to be up around 50, but 20% is a pretty common number. It reflects what the risks are in any given, say, 1 month period of how much down activity and up activity will be in the marketplace. So hopefully that gives you a good overview of how a long put option position works, and especially this look on what a drop in volatility does to a position such as this. It's pretty substantial, and it is probably the single biggest risk. You can hedge for price risk. You cannot hedge for volatility risk without selling an option against it. So it's the one area of options, long side options, that is invariably risky. So until next time, when we'll start talking about short positions, both puts and calls, thank you for visiting. It'd be great if you'd subscribe, tell your friends. Lots more good episodes coming on option fundamentals, and we'll start getting into specific trades down the line as well. Thanks for stopping by.